It is a strangely modern experience to log into a retirement account portal, stare at a screen, and just see your entire life's work summarized by a few glowing pixels.
Yeah, it really is. The level of abstraction in modern finance is just profound.
Right. We look at a number on a dashboard that bounces up and down based on, algorithmic trading or shifting global supply chains
And then
and
central bank interest rate adjustments,
yeah,
yeah. Things that you have absolutely zero control over.
exactly. We trade decades of like tangible physical labor for digital entries in a database.
And we all just operate under the assumption that the institutional web holding those numbers will remain stable indefinitely.
Which is a big assumption. So, welcome to the Deep Dive. Today, we were looking right at you, the listener, and we are tackling a subject that gets right to the heart of that foundational financial anxiety.
It's a big topic.
It is. Our mission today is to break down exactly how a Gold IRA rollover works. Specifically, if you are, completely new to the world of self-directed retirement accounts.
Which a lot of people are.
Yeah, and we're pulling our insights from a really comprehensive source guide on Gold IRAs versus traditional IRAs. Okay, let's unpack this because for decades, the standard formula was just, well, it was basically an autopilot strategy, right?
Right, yeah. You generate income, you funnel a percentage into a 401k or a traditional IRA.
You allocate it across equities and bonds, and you just let macroeconomic growth and compound interest do the heavy lifting.
That was the playbook. But, with sustained inflation eating away at real purchasing power
Oh, yeah.
and unprecedented market volatility, people are asking entirely new questions about their portfolios.
They're looking for friction points,
Yeah.
and they're questioning fiat currency strength.
And the anxiety driving those questions is entirely rational. I mean, when you allocate capital into traditional paper assets, you're inherently relying on a vast interconnected web.
A web of corporate governance and banking liquidity.
Exactly. So the goal here, and the source material points this out as a crucial baseline, the goal isn't to panic.
Right. Please don't panic.
Right. You don't need to liquidate your diversified Vanguard funds and stockpile bullion. That's not what this is.
So it's not an apocalyptic replacement for your standard portfolio.
No, not at all. The analytical question we're exploring is simply whether physical gold deserves a structural seat at the table.
Just asking if a defined percentage of your wealth should exist entirely outside of the standard paper-based banking system.
Yeah, for a very specific, historically grounded kind of diversification.
To frame this properly, we really need to look at the basics, the mechanical differences between these two ecosystems. So a traditional IRA that holds your stocks, corporate bonds, mutual funds.
ETFs, all of that.
Right. It's an entirely electronic, paper-based wealth system.
Yeah.
Like a digital scoreboard.
Right, because when you hold equity in a traditional IRA, you own a fractional legal claim on a corporation's future cash flows.
A promise, basically.
Yeah, exactly. Same with a bond. You hold a contractual promise from an entity to return your principal with a specific yield. The asset itself is the legal contract, not, a physical object.
So pushing that digital scoreboard analogy, in a standard IRA, you are essentially placing bets on the players. The companies, the governments.
Hoping they score points.
Right, hoping they score points in the form of dividends or earnings growth, and you watch the score tick up. But a Gold IRA is a completely different mechanism.
It is. It's a type of self-directed IRA that allows you to essentially put physical, tangible weight into a tax-advantaged account.
You're taking your chips off the digital betting table. You aren't betting on the players anymore. You're basically hoarding the actual base currency the stadium uses to keep the lights on.
What's fascinating here is the fundamental shift in the economic purpose of the asset itself.
What do you mean?
Well, paper assets are engineered for wealth generation. The entire thesis relies on corporate expansion and reinvested dividends.
Right, growth.
Exactly. But gold operates on a completely different historical and economic frequency. I mean, it does not generate quarterly earnings.
No.
It doesn't yield a dividend. Its primary utility is wealth preservation.
Because the supply is physically constrained by geological reality.
Right.
And mining costs.
Precisely. It has historically maintained its purchasing power over centuries. It acts as a non-correlated diversifier against currency devaluation.
So it's a shift from wealth generation to wealth preservation. Which brings us to, honestly, the biggest roadblock I think beginners face.
The liquidity myth.
Yes, busting the new money myth. Because when you hear Gold IRA, the immediate mental image is that you need massive liquidity. Like, I need $50,000 of fresh cash from my bank account to go buy a heavy box of bullion.
Right, and the source material identifies that exact misconception as the primary barrier to entry. Establishing a gold IRA does not require an injection of newly earned capital.
Which is huge. We are dealing strictly with existing retirement funds.
Yes, it is actually funded through a rollover or a direct transfer from accounts you've already funded.
Like your standard traditional IRAs or Roth IRAs or a SEP IRA if you're a freelancer.
Or even eligible past 401ks. And the operational linchpin here, the really crucial part, is that this movement of funds doesn't trigger a taxable event.
If done correctly.
Right, if done according to IRS guidelines. You preserve the tax advantage status while fundamentally changing the nature of the asset.
Okay, so let's break down that process step by step. How do we actually move the money?
Well, the IRS framework provides a pathway, but the execution requires absolute precision. There are two main ways to do it. The first is a 60-day rollover. That's where the funds are distributed to you personally, and you have exactly 60 days to deposit them into the new Gold IRA.
That sounds incredibly stressful.
The danger there is massive.
Yeah.
If you miss that window by a single day, the IRS treats the entire amount as a fully taxable distribution.
Oh, wow. So you get hit with taxes and early withdrawal penalties if you're under 59.5.
Yes. Plus, the originating custodian often automatically withholds 20% for taxes, so you actually have to make up that 20% out of your own pocket just to complete the full rollover.
That is a logistical minefield.
Yeah.
Just designed to trip people up.
It is heavily friction-laden, which is why the source guide strongly advocates for the second mechanism, the direct custodian-to-custodian transfer.
Step 1 and 2, basically.
Yeah.
Getting a specialized, self-directed IRA custodian.
Exactly. The capital moves directly from your current brokerage to the new custodian. The money never touches your personal bank account.
So that completely eliminates the 60-day countdown.
Eliminates the countdown, eliminates the mandatory tax withholding, and removes the risk of an accidental taxable event.
That makes total sense. And you really have to use a specialized custodian, right? Because if I log into my standard index fund brokerage, there is no button to buy physical bullion.
No, standard brokerages are built for electronic trades. They are not equipped to handle the acquisition, transportation, or vaulting of heavy physical metals.
So the self-directed custodian is the administrative bridge.
They ensure the mechanics comply strictly with IRS code. Once they facilitate the transfer, the capital sits in your new self-directed IRA as liquid cash, waiting for your instruction.
Okay, so step 3. The cash is cleared. Now we're turning digital cash into physical weight. We get to choose the metals.
This is the allocation phase.
And the source has a very specific roster of what is permitted, like the American Gold Eagle, the American Gold Buffalo, the Canadian Gold Maple Leaf.
The Australian Gold Kangaroo.
Yes. But wait, let me push back on this a bit. The term is self-directed IRA.
Right.
If I am directing the investments, why am I restricted to, like, a modern Canadian maple leaf?
Right.
Wait, so if I have a rare, highly valuable antique gold coin, I can't put that in.
No, you cannot. The IRS draws an absolute line in the sand regarding speculative value versus intrinsic commodity value.
So no 19th century pirate doubloons.
Definitely no doubloons. Collectibles are antiques and numismatic coins, meaning coins whose premium comes from rarity or historical significance, are explicitly out.
The IRS wants standard, verifiable purity, not speculative collectible value.
Exactly. The underlying philosophy of the tax code is to accumulate reliable assets, not provide a tax shelter for a hobby market.
So the IRS allows you to hold the underlying commodity, not the subjective opinion of a coin appraiser.
Precisely. An American Gold Buffalo has a guaranteed purity of 0.9999 fine gold. Its valuation provides liquid, frictionless price discovery based on the global spot price.
Whereas a rare coin is totally subjective until it sells at auction.
Right. And purchasing a non-compliant asset automatically triggers a distribution, stripping the tax advantage status from that capital.
Okay, so you navigate the purity codes, you buy the compliant bullion. Now we hit step 4 and 5, storage and administration. Where does this physical weight actually live?
This is a purely geographical problem, yeah.
And the source guide addresses this perfectly. The home-safe fantasy.
Oh, yes.
Because the immediate psychological urge is, if I'm buying physical gold to escape the banking system, I want to keep it in a massive vault in my basement or bury it in the backyard.
The desire for sovereign control is strong, but the IRS explicitly prohibits home storage for IRA metals.
So the backyard pirate map strategy is a direct violation of the tax code.
A violation that will result in the immediate disqualification of the IRA. You cannot store it in your home, a personal safe, or anywhere on your property.
So where does it go?
The IRS mandates that IRA-purchased precious metals must remain in the physical possession of an approved depository.
And I imagine an IRS-approved depository is a bit more robust than a safety deposit box at the local credit union.
The infrastructure is entirely different. We are talking about specialized, institutional-grade logistics facilities.
Wow.
They provide comprehensive insurance, redundant security systems, environmental controls, and routine independent audits to verify the inventory.
If we connect this to the bigger picture, this is the ultimate structural trade-off, right?
It really is.
You are relinquishing physical proximity to your asset as the required cost of preserving the IRS tax benefits. You get the diversification, but you still have to trust an institution to guard it.
It's a calculated compromise. The strict rules legitimize the account for the IRS. The government has a vested financial interest in that tax-deferred capital, so they require a neutral third party to hold it.
Which makes sense.
Yeah.
But here's where it gets really interesting. Because that compromise introduces tangible downsides.
The costs of physical reality.
Exactly.
Yeah.
I need to ask you about the hidden costs. If I leave my capital in a standard index fund, it passively generates dividends. The fees are practically zero.
Right.
Does it make sense to give up compounding interest and dividends just to hold a shiny rock that also charges me storage fees?
That is the critical analytical pivot you have to make. You have to look at the economic reality impartially. Physical gold yields zero dividends and zero interest.
It's an inert piece of metal.
Right. If you place a 1-ounce coin in a depository today, in 30 years, you still possess exactly 1 ounce of gold. There is no internal rate of return.
And you're getting recurring invoices for vault storage and custodian administration. You're experiencing a negative carry.
It costs you money annually just to maintain the position, which reinforces the primary thesis. It is a pure play on intrinsic value and diversification, not passive income.
You're paying a premium for financial insurance, a defensive anchor.
Exactly. You allocate to equities to grow wealth. You allocate to physical metals to ensure a portion cannot be inflated away.
Okay, so let's fast forward. We've weathered decades of economic cycles. You actually hit retirement age and want your money. What happens in the withdrawal phase?
The end game mechanics. So the baseline rules heavily mirror a traditional IRA. You must navigate the 59.5 age rule for penalties.
The government's lock on the vault doesn't open early without a 10% penalty.
Exactly. But the more complex logistical hurdle is the required minimum distributions, or RMDs.
Right, when the government legally obligates you to start drawing down the balance so they can finally tax it.
Yes. And this is where the physical nature of the asset creates a unique challenge.
A massive logical gap, honestly. Because let's say my RMD for the year is exactly $4,300, but my IRA holds a massive indivisible $10,000 gold bar. I can't saw a chunk off a gold bar to pay the IRS.
No, you can't. The friction of indivisibility is a major factor. When facing an RMD, custodians typically handle this via liquidation. They might be forced to sell the entire $10,000 bar on the open market.
Just to get the $4,300.
Yes. They distribute the cash to satisfy the IRS, and the remaining $5,700 sits in your IRA as a cash drag, no longer invested in metal.
That is a massive inefficiency. You're liquidating more of your hedge than you want to.
Which is why experienced investors buy a mix of larger bars for premium efficiency, but specifically acquire smaller fractional coins to create liquidity for future RMDs.
Well, it's fair.
Or they just maintain a cash buffer in the account. But ultimately, you have a unique dual exit strategy with a Gold IRA. Option 1 is what we just discussed, cash out. Sell the metals within the IRA and take the cash.
Okay, but what if the entire point of this decades-long strategy was that upon retirement, I actually wanted to hold the physical wealth?
Then you utilize option 2, the in-kind distribution.
The defining feature of the account.
Yes.
Let me guess how this works. An in-kind distribution means the gold is transferred from the IRA's name to my personal name, and they just securely ship the actual physical wheat directly to my house.
That is the fundamental mechanism, yes. The custodian calculates the market value on the day of distribution for taxes. Once accounted for, the asset is officially decoupled from the retirement structure.
And it becomes your unencumbered personal property.
Shipped via insured transit right to your door.
That is the exact moment the home safe finally comes into play.
Exactly. Once the in-kind distribution is complete, the physical chain of custody ends with you. For many, this is the ultimate realization of the Gold IRA strategy.
So what does this all mean? Synthesizing this deep dive, the undeniable takeaway is that a Gold IRA is not a replacement for a traditional stock and bond portfolio.
No, it's a complementary tool.
Right. It's for those seeking tangible asset ownership and long-term wealth preservation. It demands proactive management, it incurs logistical costs, and it requires forfeiting compounding growth.
But you are strategically accepting short-term logistical friction to gain long-term macroeconomic resilience.
A defensive anchor of true intrinsic value.
Exactly. But I'd actually like to leave the listener with a final, slightly different angle to ponder on their own.
Oh, please do.
We spend a tremendous amount of time analyzing tax codes and liquidity barriers and the granular mechanics of depository audits. But consider how your psychological relationship with your life savings might fundamentally change if, instead of just trusting a digital number on a screen, a portion of your retirement was something you could eventually hold in the palm of your hand.
Wow.
Does the mere physical weight of an asset change how secure you feel about your future?
That is a profound question to chew on. Does the physical weight fundamentally change the worry? I love that reframing. Well, that wraps up our analysis for today. Thank you so much to you, the listener, for joining us on this deep dive into the mechanics of Gold IRA rollovers.
It's been great.
Keep questioning the structure of your portfolios, keep learning and exploring your defensive options, and we will catch you on the next deep dive.